Exercise and assignment. In previous lessons, you learned that call and put holders obtain rights with the options that they've purchased, and call and put writers take on an obligation when they sell options. This lesson introduces details about how option holders might take advantage of their rights to buy or sell underlying stock, as well as how and when option writers might be called upon to fulfill their obligations. At the end of this lesson, you will be able to identify the steps a holder takes to exercise the rights of a long equity call or put option, identify the steps in the assignment process through which an option writer might be called upon to fulfill the obligations of a short equity call or put option, describe the role of OCC in the exercise and assignment process, compare and contrast American-style exercise and European-style exercise. Let's review some of the important things you've learned so far about call and put holders and the rights they've purchased. Holder, buyer. Equity call option has the right, not the obligation, to buy 100 shares of underlying stock at the stock price per share at any time before its expiration. Equity put option has the right, not the obligation, to sell 100 shares of underlying stock at the strike price per share at any time before its expiration, pays premium, non-refundable. For these rights is long the number of contracts purchased. Exercising the rights of a call or put. Thanks for the review. A logical question at this point is, how do I take advantage of these rights? How do I actually buy the underlying stock if I've purchased a call, or sell the underlying stock if I've purchased a put? Very simply, you exercise your right. You exercise the call or put contract. Holders of long equity options have purchased the right to buy for a long call or sell for a long put 100 shares of the underlying stock at the strike price at any time until the option expires. Only holders of long options, therefore, may exercise this right, as well as make the decision whether or not to do so. The right inherent in a call or put option contract is just that, a right, not an obligation. Statistics show that a majority of individual investors choose to sell long options, hopefully at a profit, rather than exercise them when it might otherwise make sense to do so. You'll appreciate how this decision is made as you continue learning about equity options. If I decide to exercise my long options, then how do I do this? Do I get in touch with the exchange where I bought them? No. Once you've carefully made the decision to exercise one or more long calls or puts, you then notify your brokerage firm of your intention and give instructions to do so. These instructions are called your exercise notice. Submitting this notice to your brokerage firm may require a phone call to a broker, or it might be accomplished electronically via email or more directly through a facility on your firm's website. Each brokerage firm may have specific procedures and cutoff times for issuing instructions to exercise equity options, so it is your responsibility to become familiar with your particular firm's rules on this matter. After exercise, a transaction. So, at what point in this process do I actually buy or sell shares of underlying stock? On the business day, you submit the exercise instructions to your brokerage firm. The exercise procedure begins and may continue overnight. Before option trading begins on the next business day, you will have bought or sold 100 underlying shares for each option contract exercised. Additionally, and this is important to understand, your brokerage account will reflect that payment for these shares will have been made or received. After long equity call exercise. For each long equity call contract, 100 shares of stock will have been purchased by your brokerage account at the option strike price per share, and the cash to pay for those shares transferred out of or debited from your account. Example, exercising an XYZ A November 75 call contract will result in the purchase of 100 XYZ shares at the $75 strike price per share. The total cash amount debited from your account will equal $75 per share times 100 shares, or $7,500. After long equity put exercise. For each long equity put contract, 100 shares of stock will have been sold from your brokerage account at the option strike price per share, and the cash received for those shares deposited or credited into your account. Example: exercising an XYZ November 75 put contract will result in the sale of 100 XYZ shares at the $75 strike price per share. The total cash amount credited to your account will equal $75 per share times 100 shares, or $7,500. American style versus European style exercise. All equity options, whether the underlying security is stock or shares of an exchange traded fund, ETF, have what is called American style exercise. This is a standardized feature of all equity options traded in the United States. Other categories of options traded in the US might have what is called European style exercise. I'm not sure I understand. American style or European style has nothing to do with where I buy or sell my options. That is correct. But let me explain these terms just a little bit further. American style option contracts are simply calls and puts that a holder, buyer, may exercise at any time before they expire. That's it. On the other hand, European style call and put options are contracts that may be exercised only at a specific point in their lifetimes, generally at their expiration. The most common of these are index options, whose values are based on an underlying index, generally a stock index of one kind or another. These are widely traded on U.S. option exchanges. Their European-style exercise feature refers only to when these contracts may be exercised. Again, only at their expiration. Okay, review. Now, let's revisit some key points we've covered so far about call and put writers and the obligations they've assumed in exchange for receiving premium at the option sale. Writer, seller, equity call option has the obligation to sell 100 shares of underlying stock at the strike price per share at any time before its expiration if called upon to do so. Equity put option has the obligation to buy 100 shares of the underlying stock at the strike price per share at any time before its expiration if called upon to do so. Receives and keeps premium for these obligations is short the number of contracts written sold. Assignment and assignment notification. A key phrase in this description of a call or put writer's obligation is if called upon to do so. The procedure through which writers are called upon is referred to as assignment. Remember that when holders of long options decide to exercise one or more contracts, they must issue instructions to their brokerage firm to do so, and that these instructions are called an exercise notification. After each exercise, an option writer is then assigned an exercise notice. How do I find out if I've been assigned then? Okay. You will be notified by your brokerage firm, generally before trading begins on the day of your assignment on a short equity option. Just like with option exercise, each brokerage firm may have their own specific procedures and timing for assignment notification on a short equity call or put, so it's your responsibility to become familiar with your particular firm's rules on this matter as well. A very important point to understand about assignment on a short equity option is that by the time you're notified, your obligation has already been fulfilled. You will have bought or sold underlying share per terms of your short contract, and cash will also have been transferred out of or into your account. Strike price is not premium. Premium and strike price represent two entirely different things. Premium is strictly the total cash amount you pay or receive for an option after a trade on an option exchange. It is non-refundable for an option buyer. An option writer keeps the premium whether assigned or not. An option strike price, on the other hand, is the price per share paid or received for underlying stock after exercise or assignment. After short equity call assignment. For each short equity call contract, 100 shares of stock will have been sold from your brokerage account at the option strike price per share, and the cash received for those shares deposited or credited into your account. Example, assignment on a short XYZ November 75 call contract will result in the sale of 100 XYZ shares at the $75 strike price per share. The total cash amount credited to your account will be equal $75 per share times 100 shares, or $7,500. After short equity put assignment, for each short equity put contract, on the other hand, 100 shares of stock will have been purchased by your brokerage account at the option's strike price per share, and the cash to pay for those shares transferred out of or debited from your account. Example, assignment on a short XYZ November 75 put contract will result in the purchase of 100 XYZ shares at the $75 strike price per share. The total cash amount debited from your account will equal $75 per share times 100 shares, or $7,500. Buyer and seller. Literally speaking, anybody who sends a buy order to an exchange can be called a buyer. It is common practice in the options industry, however, to use the terms buy and buyer generically to mean purchasing a call or put option along with the right the long contract grants and becoming the long option's holder. If the holder decides he or she no longer wants the option and its rights to buy for a call or sell for a put underlying shares, that option may be sold in the marketplace if there are currently buyers willing to pay for it. On the other hand, anybody who sends a sell order to an exchange can be called a seller. But in the options industry, the terms sell and seller are used generically to refer to writing, or the investor who writes a call or put option, taking on the obligation of that short contract. If an option writer decides he or she no longer wants the obligation to sell for a short call or buy for a short put underlying shares, to void the obligation, the writer may buy an option with the same terms in the marketplace. As you learn more about options, when you see or hear any of these terms in the sense in which they are to be taken, should be clear from the context in which they are used. To help you out, we'll use the term holder to specify an investor who has purchased a long option along with its right. We'll use the terms right or writer to specify any investor who is selling a contract and taking on its obligation. Assignment, American style versus European style. Something just occurred to me. Since equity options are American style contracts, can I be assigned at any time before expiration on equity options I've written? That's another good question. You're thinking carefully about all of this. And yes, the answer is yes, you can. American style exercise works both ways in this respect. Since equity option holders may exercise long calls or puts at any time before expiration, you or any investor who has written equity calls and or puts may be assigned at any time before they expire. You'll learn later on that you might expect assignment under certain circumstances. For now, however, the important thing to remember is simply that all equity options traded on the U.S. exchanges are American style and may be exercised or assigned at any time before they expire. Role of OCC. A crucial role in the process of exercise and assignment is played by the OCC. This role, as well as others played by the OCC, will be fully explained in a subsequent class. At this point, however, let's consider the process of assignment. After options are exercised, assignments are ultimately made on a random basis by the OCC. In other words, after you exercise a long call or put, any investor with a short position, an option writer, in the same contract may be assigned, not just the person who sold you the option in the marketplace to begin with. Okay, points to remember. In order to buy for a call or sell for a put 100 shares of underlying stock, an equity option holder exercises the contract by submitting instructions to do so to his or her brokerage firm in the form of an exercise notice. An equity option writer is called upon to fulfill the obligation to sell for a call or buy for a put 100 shares of underlying stock by being assigned an exercise notice by his or her brokerage firm. Equity options are American-style contracts. They may be exercised and assignment may be received at any time before they expire. Assignment is made on a random basis by OCC. Option contracts, like many other types of contracts you might be party to, expire at some point. And as we've discussed many times up to this point, option contracts are no different in this respect. They all have an expiration date, which is one of the standardized terms of any equity option contract. If a long call or put option has not been exercised before the expiration date, the contract ceases to exist. The option holder no longer has any rights, and the option becomes worthless. And from an option writer's point of view, any short call or put contract on which assignment has not been received, has not been assigned, also ceases to exist. The writer no longer has any obligations and the option becomes worthless. In either case, the option is said to have expired, worthless or with no value. At the end of this lesson, you will be able to identify and describe expiration date, define equity leaps, and list how these options' lifetimes are different from regular equity option lifetimes. Expiration month. When you go to the option marketplace to buy or write an option, you will find a choice of months in which the option will expire. What will be my choice of expiration months? Well, for equity options based on particular underlying stock, you will usually find at least 4 expiration months to choose from in the marketplace. And these available months are determined by the option exchanges according to their guidelines. The maximum lifetime for a regular equity option is about 8 months. After it first becomes available to trade, although some may have fewer or more expiration months available at any given time. Expiration day, the actual day on the month on which an option expires, is standardized. If the expiration date is standardized, then each month it occurs on the same date, right? You would think so, but no, not exactly. It's the method of determining each month's expiration date that is standardized. Regular equity options actually expire on the 3rd Friday of their expiration month. That is literally expiration day, after which an option that has not been exercised or assigned will cease to exist. Expiration dates are determined this way in order to provide approximately 4 weeks between one and the next. Expiration Friday, last day to trade, and last day for exercise. The last day option holders may submit exercise instructions to their brokerage firm is the 3rd Friday of its expiration month. This is commonly referred to as Expiration Friday. If that Friday is an exchange holiday, so let's say Christmas Day, then the last day options may be traded or exercised will generally be the prior business day or Thursday. Again, each brokerage firm may have its own cutoff time for submitting an exercise notice on Expiration Friday, and this cutoff time may be different than that specified for early exercise, any day before Expiration Friday. In either case, it will generally be after the close of option trading on the day of exercise. Notification of assignment at expiration should be received before option trading begins on the next business day after the expiration date, generally the next Monday morning. Regular equity option. Okay. We've used the term regular equity option frequently up to this point. This is simply a call or put option with the standardized contract terms we've discussed. 100 underlying share unit of trade. American style exercise at any time before it expires. Expiration date on the third Friday of its expiration month. Equity leaps. You just learned that regular equity options have lifetimes of up to 8 months after they're available for trading. However, there are equity leaps, calls and puts, which are just like regular equity options, but with longer lifetimes. They may expire up to approximately 3 years after they are available for trading. A distinguishing feature of equity leaps, however, is that they expire the third Friday in only January of their expiration year. What does LEAPS actually stand for? It's an acronym for Long-Term Equity Anticipation Securities, SM. These contracts are widely used by investors, especially those with longer-term investment outlooks on their underlying stocks, or at least longer than 8 months. So currently, approximately 25% to 35% of stocks that have options available will have LEAPS available for trading as well. Identifying LEAPS contracts. LEAPS calls and puts are identified in the same manner as short-term, regular equity options, except that you might find an expiration year after the expiration month. Examples of XYZ LEAPS. LEAPS calls, $50, strike price, XYZ, Jan, 1250, call expiring, Jan 2019. XYZ Jan 1350, call expiring in Jan 2020. LEAPS puts, $75 strike price, XYZ Jan 1275 put, expiring in January 2019. XYZ Jan 1375 put, expiring in Jan 2020. Points to remember, okay? Expiration day for equity options occurs on the third Friday of their expiration months. An equity option that has not been exercised or assigned before its expiration date will cease to exist. It will expire worthless. For equity options on a particular underlying stock, an investor will find a number of expirations months to choose from in the marketplace, as far as 8 months in the future. The last day an expiring option will trade in the marketplace, and the last day an option holder may exercise is the third Friday of the month. Equity leaps contracts are like regular equity options with the longer lifetimes. Their expiration dates may be up to 3 years in the future. Before you place an option order with your brokerage firm, you'll need 5 pieces of information regarding the option contract you want to buy or sell. All of this information can be found online in various websites, conveniently formatted in an array of data called an option chain, including available expiration months, available strike prices, option prices in the marketplace. Reviewing the information on an option chain should help you to select the specific option contract that fits your investment objective. Once the option is identified, you're ready to place your order to buy or sell. We'll cover the types of information you might find on a typical option chain, as well as some peripheral topics. Directory of exchange-listed options, option expirations, option symbology keys, leaps. Expiration months. For all exchange-listed equity options, there is a method that determines the expiration months available for any option class, i.e. all calls and puts on a specific stock at any given time. Quarterly cycles. When the listed options market began, and for many years thereafter, all equity option classes were assigned to one of 3 quarterly cycles. With the expiration 3 months apart, quarterly cycles, January cycle, cycle 1, February cycle, cycle 2, March cycle, cycle 3. Expiration months, January, April, July, October. February, May, August. November, March, June. September, December. Today, available expiration months for equity options no longer occur on a quarterly basis, but instead on a sequential cycle. However, each option class is nevertheless appointed one of the older quarterly cycles. Sequential expiration cycle. According to the sequential expiration cycle, each class of your options will generally have 4 expiration months available at any given time, 2 nearest term, consecutive calendar month next to farther term months from its appointed quarterly cycle. In general, 2 near-term months plus 2 additional months in the January, February, or March quarterly cycle. However, different exchange programs allow for expiration month listing beyond the standard method. Congratulations! You've just completed this course and may be ready to take the next step of your trading journey. The option terms and concepts we've just covered are among the most basic, with the definitions and explanations brief and to the point. You have learned what equity option contracts are, what it means to buy or write them, and what happens after exercise or assignment. Familiarity with all of these will serve as a solid foundation on which to both build your option vocabulary and expand your understanding of exchange-listed equity options. In today's option market, there may be dozens of different option contracts available for trading on each stock that underlies listed options, and the number of those stocks is well over 3,000. In today's option market, there may be dozens of different option contracts available for trading on each stock that underlies listed options, and the number of those stocks is well over 3,000. Thanks to easy access via the internet, investors can obtain a market quote for any call or put contract, i.e. bid and ask price, simply and quickly and on any exchange where the option is listed and traded. Resources for these quotes are numerous. This class will introduce you to where you might find option quotes online and what you might find when you get there.